You tap your card, a green light blinks. You grab your bag and walk out. That gesture, the tap, the blink, the approval, took 1.5 seconds. In those 1.5 seconds, your card number traveled through at least 4 separate financial institutions, was authenticated by a fraud detection algorithm running over 500 variables simultaneously, was checked against your credit limit, and triggered a revenue split between your bank, the store's bank, and a payment network, all before the cashier handed you your receipt. You did that without thinking. You've done it thousands of times, but almost no American can explain what actually happens when they swipe, or why the piece of plastic in their wallet is one of the most sophisticated financial instruments ever mass-produced. Americans carry $1.1 trillion in credit card debt right now. The industry earns $130 billion per year in interest and fees alone. Every dollar of that was extracted through a system most cardholders have never seen. This is the credit card, and you're about to actually understand it. The forgotten lunch that built an industry. The modern credit card was born from an embarrassing dinner. In 1949, a New York businessman named Frank McNamara finished a meal at Major's Cabin Grill in Manhattan and discovered he'd left his wallet at home. His wife bailed him out. McNamara was humiliated. He was also inspired. Within a year, he launched the Diners Club card, a cardboard membership card that lets subscribers charge meals at 27 New York restaurants and settle the balance monthly. By the end of 1950, it had 20,000 cardholders. By 1955, it was international. Bank of America saw the model and bet everything on it. In 1958, they mailed 60,000 unsolicited credit cards to residents of Fresno, California, a mass drop they called the Fresno Drop. It was chaotic, legally questionable, and wildly successful. Fraud was rampant. Delinquency was high. They did it anyway because the upside was too enormous to ignore. The Fresno Drop became Bank Americard. Bank Americard became Visa. The entire American credit card system grew from 60,000 pieces of plastic dropped on a California city like junk mail. Everyone who gets paid. When you swipe, a credit card transaction is not a two-party exchange between you and the store. It is a four-party revenue event. The four parties, you, the cardholder, the merchant, the store, the issuing bank, Chase, Citi, Capital One, whoever issued your card, and the payment network, Visa, Mastercard, Amex, or Discover. When you pay $100 at a store, the merchant receives approximately $97.50 to $98.00. The remaining $2 out to $2.50 is the interchange fee, split between your issuing bank, the largest cut, roughly 1.52%, the payment network, a smaller toll, 1, 0, and 15%, and the merchant's bank. Interchange fees generated $72 billion in revenue for American banks last year, paid entirely by merchants who passed the cost into product prices. Whether you pay cash or card, you are paying interchange fees. Cash customers subsidize rewards cardholders without receiving any of the benefits. The credit card swipe is invisible taxation on merchants, on cash users, and ultimately on every American consumer, whether they know it or not. Who really pays for your free flight? The most seductive thing about a credit card is the rewards program. It is also the most carefully engineered illusion in consumer finance. Chase Sapphire, Amex Gold, Capital One Venture. These cards promise cash back, travel points, airline miles, hotel nights, all free, simply for spending money you were going to spend anyway. The pitch is that you win just by using the card. Here's where the rewards actually come from. Premium rewards cards charge merchants 3 or 4% interchange fees rather than the standard 1.52%, generating the extra margin that funds your miles. When you earn a free flight, it was quietly charged to every store you visited over the past year. Research by the Federal Reserve Bank of Boston found that rewards programs redistribute wealth from lower-income Americans to higher-income ones. High-income households carry premium rewards cards and collect points. Lower-income households are more likely to carry balances and pay interest on basic no-rewards cards, funding a financial ecosystem they don't benefit from. Your free flight to Cancun was partially funded by a neighbor who couldn't pay off their balance last month. That is the hidden economics of the American rewards card. the most expensive math in America. The minimum payment line on your credit card statement is one of the most profitable numbers in banking history. A $5,000 balance at a standard 24% APR paid with only the minimum monthly takes 17 years and 4 months to clear. Total interest paid, $7,236, nearly 150% of the original balance. You spend $12,236 to retire a $5,000 debt. Banks know this math exactly. The minimum payment is calculated to keep you in debt as long as possible while keeping the monthly amount low enough to feel manageable. Typically 1 to 2% of the balance. Low enough to feel achievable, high enough to feel responsible. It is neither. The Credit Card Act of 2009 required banks to print payoff timelines on statements for minimum payment cardholders. Banks lobbied against this disclosure requirement harder than almost any other provision in the law. They knew what those numbers would do to cardholders who finally saw them clearly. The minimum payment is not a financial floor. It is a retention strategy. How 29% APR became legal in America. The average American credit card APR right now is 27.6%, the highest ever recorded. For context, a 30-year mortgage averages around 7%. A car loan around 9%. Student loans 6–8%. A credit card charges 3 to 4 times more than any other major consumer debt product on unsecured revolving debt with no collateral, issuable in minutes. The answer to how this is legal runs through a 1978 Supreme Court case, Marquette. National Bank versus First of Omaha. The ruling held that banks could charge the interest rate legal in their home state to customers anywhere in the country. Within years, Delaware and South Dakota, desperate for banking employment, eliminated their usury caps entirely. Every major credit card issuer immediately relocated their operations there. Today, Chase's card operations are legally domiciled in Delaware, Citibank in South Dakota, Capital One in Virginia, which followed suit. A single Supreme Court ruling turned American consumer lending into a race to the bottom. The bottom has no floor. The number that controls your life. Your credit score is not a measure of your financial health. It is a measure of your profitability to lenders. The FICO score, created by Fair Isaac Corporation in 1989, used in over 90% of all U.S. lending decisions, ranks you from 300 to 850 on 5 factors. Payment history, 35%. Amounts owed, 30%. Length of credit history, 15%. New credit, 10%. Credit mix, 10%. Notice what is absent: your income, your savings, your net worth, your assets. A millionaire who has never used credit has a lower FICO score than someone carrying $30,000 in card debt who makes minimum payments on time. The system is not measuring wealth. It is measuring how reliably you will generate interest income for banks. Your score follows you everywhere. Mortgage rate, car loan rate, apartment application, insurance premium in most states, and in some cases your job application. A 3-digit number generated by a private corporation using a proprietary algorithm you cannot examine dictates the cost of nearly every major financial transaction in your adult life. What every digit actually means, the 16-digit number on your credit card, is not random. Every digit has a specific, deliberate meaning. The first digit is the major industry identifier. A 4 means Visa. A 5 means Mastercard. A 3 means American Express. A 6 means Discover. Before you see any logo, the first digit already identifies which network routed your last transaction. Digits 2 through 6 form your issuing bank's bank identification number, a globally unique code assigned to every financial institution in the world. When a merchant runs your card, these 6 digits route the transaction to exactly the right bank before any account verification occurs. The final digit is the most elegant. A mathematical checksum calculated by the Loon algorithm, a formula invented by IBM scientist Hans-Peter Loon in 1954. It adds the digits in a specific alternating pattern, and if the result isn't divisible by 10, the card number is mathematically invalid and rejected instantly. A 70-year-old IBM formula runs on every credit card transaction on Earth, invisibly, in under a millisecond. The AI that watches. Every purchase, every credit card transaction is reviewed by an artificial intelligence before the approval arrives, in under 100 milliseconds. Visa's fraud detection system processes 76,000 transactions per second globally. Each one is analyzed against over 500 behavioral variables. Your typical purchase patterns, the merchant's fraud history, the device being used, the time of day, your geographic position relative to your last transaction, the velocity of recent charges, and dozens more. The system knows you better than you know yourself. It knows you never buy gas in New Jersey. It knows you buy coffee at 7:42 a.m. 3 days a week. It knows you occasionally order food online late on Friday nights. Any deviation, a purchase at 3 a.m., a foreign gas station, a round dollar charge at an unusual merchant, triggers a real-time risk score adjustment.